Welcome back to The Explainer, everyone. I am so glad you're here. Look, the crypto space is absolutely notorious for its wild, unpredictable swings, right? But figuring out if a project is just a victim of a bad market cycle or an actual structural scam, well, that's what separates the successful investors from the rest of the pack. So today, we're going on a bit of a journey to distinguish between struggling real-world crypto companies and outright deceptive illusions in the digital asset space. It's a crucial skill, and we're going to build it together right now by looking at the hard data.
Okay, let's look at our roadmap for today. We'll start with the crypto winter reality, move into analyzing miners' value or trap, then pivot over to the Origin LGNS collapse, unpack the anatomy of a scam, and finally wrap up with spotting the illusions. All right, section 1, the crypto winter reality, the devastation of digital assets. Now, to really get a grip on our analysis today, we've got to rewind to the brutal reality of the 2022 market crash. 80%. Just let that number sink in for a second. During the 2022 crypto winter, public companies doing the actual physical heavy lifting of securing blockchain networks, the proof of work miners, literally saw their stock values evaporate by an average of 80% from their 52-week highs. And for those who might not know, proof of work mining isn't just some software running quietly on a laptop in a basement. We're talking about massive stadium-sized warehouses packed to the ceiling with highly specialized, incredibly expensive computers running 24/7. It's a massive industrial scale operation. So an 80% wipeout, that is a staggering erosion of value for public, audited companies doing very real work. This data from Valkyrie Investments really paints a picture of just how severe things got. A basket of crypto mining stocks actually suffered a worse drawdown than Bitcoin itself. Bitcoin took a rough 65% drop over this period, but the miners, they fell even further. Why? Well, it comes down to fixed costs. Think about it. If the price of the digital asset you're producing gets cut in half, your electric company doesn't magically cut your power bill in half, right? Your lenders certainly aren't forgiving the massive debt you took on to buy those high-end rigs. When the underlying asset plummets, but your operational costs and leveraged balance sheets stay exactly the same, your profit margins don't just shrink, they completely vanish. It really begs the question, how do you possibly keep the lights on? Moving right along to Section 2, Miners, Value or Trap, Analyzing the Survivors. Let's shift into some grounded financial analysis and explore how we evaluate these publicly traded miners when the broader market is just bleeding out. The difference between survival and bankruptcy usually comes down to basic fundamentals. Instead of staring at endless, headache-inducing spreadsheets, you really just need to ask one simple thing. Who has more cash than debt? It perfectly juxtaposes our two categories. On one hand, you have the survivors. These are your potential value stocks poised to bounce back. They've got low debt, high liquidity, and remarkably low production costs. Basically, they have the actual financial fuel to weather the storm. On the other hand, we have the value traps. These guys are drowning in negative cash flow, high debt, and high variable costs. If it costs you more in electricity to mine a block than the reward you get for mining it, well, your business model is completely broken. You're destined to fold. Take a look at this. When you look at the average production cost per Bitcoin for highly efficient miners, you see a fascinating reality. You've got a company like BTBT producing at a cost of just $7,771 and Riot coming in around $13,590. Keep in mind, with Bitcoin sitting near $23,300 at the time of this specific analysis, these companies had a massive margin of safety. They weren't just squeaking by. They were still producing crypto way above their direct variable costs, even in the middle of a harsh crypto winter. This is what a real, tangible business model looks like. Sure, they face severe market pressures, but the underlying math of their business still made perfect sense. But what happens when the business model itself is the actual trap? Let's get into Section 3, the Origin LGNS collapse, a pivot to DeFi deception. Okay, we're leaving the regulated public hardware companies behind and heading straight into the Wild West of decentralized finance. A tech-wrapped Ponzi cult. Wow, just let that sink in for a second. This dramatic assessment from investigative journalist Danny Daig tells you right away that we are way out of traditional finance territory now. We aren't talking about electricity costs or audited balance sheets anymore. We're looking at allegations of a deliberate, highly sophisticated illusion. Calling something a Ponzi cult in the digital age implies this really potent mix of blind devotion masking predatory mechanics. People weren't just making a bad investment. They were essentially being indoctrinated. The gap between what was aggressively sold to the public and what was actually delivered here is just wild.
The promise? A brand new financial civilization based on a supposedly stable algorithmic coin. It had a heavily marketed $2 billion valuation, and the LGNS token even hit over 84 bucks. And honestly, the market totally bought the story at first. But then, you look at the reality. A relentless 95% price crash that dropped the token under 5 bucks. Even weirder, public data showed zero circulating supply. The grand vision didn't just struggle, it completely collapsed in on itself. Which brings us to Section 4, Anatomy of a Scam, Unpacking the Origin Mechanism. So, here is the million-dollar question. If analysts calculated this token had an 80% probability of just stagnating in a death spiral, how on earth was the project still bringing in new users and new money? Well, it wasn't growing because of groundbreaking Polygon network tech. It was growing because of textbook pyramid scheme mechanics, a multi-level marketing engine. It worked in 3 easy steps. Step 1, recruit new users. Step 2, donate your own crypto back into the system to climb the ranks and earn these bizarre cult-like titles like Believer or Master. It's brilliant gamification, right? It makes users feel incredibly special and invested in the hierarchy. And finally, step 3, take a cut of the money your new recruits brought in. The whole ecosystem ran on one golden rule: new money pays off the old money. And honestly, the technical foundation was just as terrifying as the marketing. Security audits from highly reputable firms like Certic found undeniable red flags. We are talking about an unverified smart contract, meaning absolutely nobody could check the underlying code to see what it was actually doing. Plus, a staggering 99% of tokens were controlled by just the top 10 wallets. Talk about centralization. Throw in an anonymous team, severe withdrawal restrictions holding users' money hostage, and a single admin who had the power to literally drain the entire treasury at any moment. The bitter irony here? In a world supposedly built on decentralized finance, LGNS represented absolute total control by a hidden few. All right, wrapping things up with Section 5, Spotting the Illusions, Lessons for the Focused Learner. Let's pull this all together. What's really interesting about synthesizing these 2 very different stories is what it teaches us about cognitive barriers. Listen, if a project is bragging about having 137 sets of smart contracts, run the other way. That is usually just word salad meant to obscure the fact that there is no actual profit model. While real mining companies transparently struggle with actual debt and electricity costs, scams use technical jargon to trick you. They want you to feel overwhelmed. They want you to think ordinary people just can't possibly understand their genius, so you might as well just trust them. Remember this, when a project needs a mountain of indecipherable jargon to prove it's safe, they are almost certainly hiding a fatal flaw. So, as we finish up this explainer, here's what I want you to ask yourself before you ever lock your hard-earned money into the next massive crypto hype cycle. Is it real innovation or just a carefully crafted illusion? Does it have a verifiable business model with a tangible margin of safety, like those highly efficient public miners? Or is it just a tech-wrapped pyramid relying on endless recruitment and cult-like devotion? Always demand transparency, look right past the jargon, and protect your focus. Thanks so much for learning with me today, and I'll see you in the next explainer.